Every year, millions of Australians lodge their tax return and quietly overpay. Not because they did anything wrong, but because they only claimed the obvious stuff and skipped a whole list of deductions they were fully entitled to. The ATO says you can deduct any expense you incur in earning your income as long as it is not private, capital, or reimbursed. Yet most people stop at a bit of car use and a couple of receipts. Today, I'm walking you through 10 deductions people miss and exactly how to claim each one. By the end, you will know what to look for and where to enter it. Here is why this matters. An Australian on the average full-time wage who misses just $1,000 of legitimate deductions each year can end up paying about $7,500 more tax over 10 years than they needed to, assuming a marginal rate of 32.5% plus the Medicare levy. That is not from some clever scheme. That is just money you were entitled to keep and never claimed. And the ATO itself flags this area. Australians claimed around $7 billion in just 3 categories of work-related expenses in a single year. An area where people both overclaim and underclaim because they do not understand the rules. So let us get the rules right. Deduction 1. Union and professional membership fees. If your membership relates to your current employment or profession, it is deductible. Many unions and professional bodies charge between $400 and $800 a year at a 34.5% marginal rate, including the Medicare levy. That is between $138 and $276 back each year that plenty of members never claim. Pull your annual statement and enter it under D5, other work-related expenses in your return. Deduction 2. Income protection insurance. Premiums that insure against loss of income are deductible. The catch is that life, trauma, and critical illness insurance are not. A typical standalone income protection policy costs between $600 and $1,200 a year, which translates to roughly $207 to $414 in tax, saved at a 34.5% marginal rate. Check your policy statement, separate out the income protection portion, and claim it. Deduction 3. The cost of managing your tax affairs. The ATO explicitly allows a deduction for this, including registered tax agent fees and some legal or accounting advice about tax. If you paid $200 to a tax agent, you effectively get $69 back at a 34.5% rate. Yet many first-timers never claim it. Keep the invoice and enter it under cost of managing tax affairs the following year. Deduction 4. Home office running costs. If your home is genuinely used to earn income, you can claim extra electricity, heating, cooling, internet, and the decline in value of equipment. For someone working regularly from home, these often total several $100s a year, easily worth over $100 in tax savings for basic claims, and more with a dedicated office and high usage. Keep a 4-week diary of your usage and either use the ATO fixed rate method or a reasonable actual cost split. Deduction 5. Phone and internet. You can claim the work-related portion of both. Say 30% of your mobile use is for work and you spend $70 a month. That is about $252 a year you can claim. Add a 20% work split on an $80 a month internet plan and that is another $192. The key is a 4-week log showing work versus private use, so your percentage is defensible. Keep the log and the bills. Deduction 6. Self-education directly related to your current job. If a course maintains or improves the skills you use in your current role, it is deductible, along with textbooks, trade journals, stationery, computer use, and some travel. A short course costing $1,000 can reduce your tax by about $345 at a 34.5% rate if it is fully deductible. The trick is the link to your current role, not a future career change. Deduction 7. Donations to deductible. Gift recipients. Gifts of $2 or more to a registered DGR are deductible. You can even claim up to $10 of bucket donations of $2 or more each without a receipt. Many people give hundreds of dollars to charity each year and never enter it on their return. Check the organisation is a registered DGR. Keep your receipts and enter the total under gifts or donations. Deduction 8. laundry and uniforms. If you wash eligible work clothing at home, you can claim $1 per load for work-only loads or 50 cents per load for mixed loads. It sounds small, but 3 mixed loads a week works out to about $78 a year in laundry deductions. No receipts needed for this, just a reasonable estimate of your loads. Note the clothing has to be a genuine work uniform or protective gear, not ordinary clothes. Deduction 9, and this is the big one. Most Australians under 75 can claim a deduction for personal contributions to a complying super fund within the concessional contributions cap, currently $30,000 a year for most people. Every extra $1,000 contributed this way saves your marginal tax rate up front, say 34.5%, versus the 15% contributions tax inside super. That is roughly $195 per $1,000 in your favour. Check your remaining cap in ATO online services first. Deduction 10 is really the step that makes Deduction 9 work. After you contribute from your after-tax money, you must lodge a Section 290-170 notice of intent to claim or vary a deduction with your super fund and receive written acknowledgement before you lodge your tax return. Miss that step and your contribution is treated as a non-concessional after-tax contribution. You lose the deduction entirely and you effectively pay your full marginal rate instead of the concessional 15%. So the form is not optional, it is the whole point. Let me make that super move concrete. Take a 38-year-old who could afford an extra $3,000 a year into super as a deductible contribution. Right away, that saves about $585 in income tax each year from the gap between her marginal rate and the 15% contributions tax. But the real magic is compounding. Repeat that $3,000 contribution for 29 years at a 5% real return. And that one habit could grow to roughly $184,000 by retirement. That is the difference between knowing this deduction exists and never using it. And the everyday deductions add up faster than people think. Take a nurse on $95,000. Between union and registration fees, income protection, laundry, and her phone, internet, and home office use, she found about $2,272 a year in deductions she had simply never claimed. At her marginal rate, that is around $783 back in her pocket every single year, just from things she was already paying for. Over 29 working years, that is roughly $22,700 in extra tax she would otherwise have handed over. Now, the biggest mistake of all, thinking that if you do not have receipts for everything, it is safer not to bother claiming. Wrong. The ATO lets you claim legitimate expenses as long as you can show how you worked out the amount and that you actually incurred it. For laundry, you can use set rates without receipts. For phone and home office, you can use diaries and reasonable percentages. The real risk the ATO warns about is claiming private expenses, like ordinary clothing or personal streaming, as work-related, so do not underclaim out of fear. Just keep simple records. The other common mistake is the opposite problem, overclaiming. In recent tax years, the ATO highlighted $7 billion already claimed for travel, clothing, and self-education, and warned taxpayers to stop claiming private expenses as work-related. That means scrutiny is rising on those exact categories. So a portion, honestly, only claim the work-related share. Never claim ordinary everyday clothing. And hold your records for 5 years. Claim everything you are entitled to, but nothing you are not. That is how you stay both maximised and safe. Let us run the checklist. 1. Union and professional fees. 2. Income protection premiums. 3. The cost of managing your tax affairs. 4. Home office running costs. 5. The work share of your phone and internet. 6. Self-education tied to your current job. 7. Donations to registered DGRs. 8. Laundry and eligible uniforms. 9. A personal deductible super contribution. And 10. Lodge that Section 290-170 notice so the super deduction actually counts. Work down that list before you lodge and you could be hundreds, even thousands better off. If this helped, do 2 things. First, go and check your last return against this list before you lodge the next one. Second, subscribe, because next up I am breaking down exactly how the personal super contribution deduction works step by step, including the notice of intent form and the timing traps that catch people out. This is general information only, not financial advice, so check your own situation or chat to a registered tax agent. But now you know what to look for. See you in the next one.